Welcome to the Deep Dive. Today we're delving into a concept that has, well, quietly shaped our economies and societies for thousands of years. Interest. It sounds simple, right?
Yeah.
Just a number on a loan.
Yeah, seems straightforward.
But the history of interest, as one source notes, is actually a discouragingly wide range of overlapping and contradictory theories.
It really is. No wonder that 19th century economist Henry Dunning MacLeod, he once quipped that the study of monetary questions is one of the great causes of insanity.
I can see why. It's a concept that's both incredibly fundamental to our economic lives
Absolutely.
and, as we'll hopefully uncover today, historically and profoundly unsettling.
It's almost like a hidden force, isn't it, operating beneath the surface?
Exactly. So our mission today is to really unpack interest rates, not just as that financial percentage, but as, a central complex force, one that's shaped entire civilizations and even our very understanding of wealth.
Right.
We're going to trace its surprising history and its profound, often unexpected modern impact.
And our insights today are mainly drawn from a truly fascinating book called The Price of Time. It makes a pretty compelling case, actually, that many of the challenges we face right now, things like financial fragility, rising inequality, they can be traced back directly to this recent era of ultra-low interest rates.
Okay, let's unpack this right from the very beginning now. Let's trace it all the way back to ancient Mesopotamia.
Okay.
The Sumerians, believe it or not, had this, chillingly accurate phrase for compound interest. Mash.
Mash. Yeah.
It literally implied livestock replicating itself. Can you imagine the power of that image? Describing debt just multiplying.
Multiplying out of control, becoming unpayable. It's incredible how that ancient problem of compounding debt just continues to echo through history.
Absolutely.
I mean, consider the English philosopher Richard Price back in the late 18th century.
Okay.
He did this calculation that a single penny put out at just 5% compound interest from Christ's birth would, by his time, 1773, have grown into more money than 150 million globes.
Whoa.
Globes the size of the Earth, all solid gold.
That's unbelievable.
It is. And both Karl Marx and Pierre-Joseph Proudhon cited this astonishing calculation. It shows its enduring power as a concept, something that disturbed thinkers across centuries.
Just mind-boggling. It really underscores why, for so long, interest was such a deeply controversial idea.
Definitely.
Sir William Blackstone, in his 1765 commentaries on the laws of England, he tried to distinguish interest as, fair compensation.
Right.
From usury as unlawful taking. But for centuries, usury, just charging interest on money, was widely condemned.
And what's truly striking is the sheer weight of historical figures who spoke out against it. I mean, you've got Aristotle, Plato, St. Augustine, Thomas Aquinas, Dante, Luther, Marx.
Wow, that's quite a list.
It spans the entire political and philosophical spectrum. And look, it's not just ancient history. You still see echoes today.
How so?
Well, the Archbishop of Canterbury, for instance, launched what he called a war on Wonga, that UK payday lender.
Right, I remember that.
And even activists from Extinction Rebellion have called for the abolition of interest. It speaks to a deep sort of underlying moral intuition about it.
It's a very deep-seated moral objection, isn't it? Though, interestingly, even some historical figures were a bit inconsistent.
Oh, like who?
Seneca, the Roman philosopher, at one point he compared usury to murder, called it an unnatural development of human covetousness, a blood-sucking 12% interest. Strong words.
Very strong.
Yet he also discussed the sale of time in a less condemnatory way elsewhere.
That raises a fascinating question, doesn't it? How did society shift from time being seen as something that, belonged to God,
Right.
to it becoming a human possession, something you can own and sell?
The Italian Renaissance humanist Leon Battista Alberti captured this shift perfectly, I think. He stated, "I would sooner lose sleep than lose time."
Meaning
Letting the right moment for doing something slip by. As the historian Fernand Braudel observed, this signaled a profound change. Time became a human possession to be valued and eventually sold via interest.
a commodification of time itself.
Wow. But even with these powerful moral and religious bans in place, human ingenuity, or maybe just necessity, found a way.
Oh, absolutely. Medieval bankers and merchants, like the famous merchant of Prato,
Yeah.
they discovered countless ways to evade the church prohibitions on interest.
Such as?
Well, they were remarkably creative. They might overstate the loan amount up front, or demand repayment in unclipped coin, a practice called coviatize, which effectively charged a hidden premium.
Sneaky.
Very. Or they'd set impossibly short repayment periods with interest hidden in heavy penalties for late payment. Sometimes they'd disguise it as fictional sales. Bankers in northern Italy used all sorts of euphemisms.
Like what?
Yield, gain, reward, profit, fee, or even a discretionary gift called discrezione.
A gift. Seriously.
Seriously, even church cardinals apparently placed their money on discrezione with these bankers.
So it was almost an open secret then, a kind of sophisticated wink and a nod system.
Pretty much. There's a quote from Jesuit Father Diego Linas. He summed it up perfectly. "The merchants have so many tricks, we can hardly see what is going on." It just became futile to enforce the ban, especially as trade expanded and the demand for credit became, well, overwhelming. You simply couldn't stop it.
And it's compelling how the legal term interest from Roman law,
Which meant compensation for a defaulting debtor.
right, how that actually tied into the concept of opportunity cost for a creditor who was deprived of their capital.
Exactly. And later, figures like David Hume and Adam Smith linked interest more explicitly to a fair share of profits that a lender might have earned if they'd used their capital elsewhere.
So it shifted from a moral condemnation to more of an economic calculation.
Precisely.
And this brings us to understanding interest not just as a moral question, but as a pure fundamental economic force.
Right.
One of the core concepts here is time preference. Think about the famous marshmallow test.
Ah, yes, the kids and the marshmallows.
Exactly. Those preschoolers choosing 2 marshmallows later over 1 now, they're exhibiting what economists call positive time preference. They value the present more.
It's human impatience, essentially, crystallized into a market rate. That's how Irving Fisher so aptly put it.
That's a great line.
And the development economist William Easterly illustrates this beautifully. Becoming rich is often a choice between today's consumption and tomorrow's. If you cut consumption to save...
You're showing a lower time preference.
Exactly. And you get richer through interest earnings, theoretically.
Benjamin Franklin captured this productive nature of money so well in his Advice to a Young Tradesman. He wrote, "Money is of a prolific generating nature. Money can beget money."
And its offspring can beget more, and so on. It's almost like a biological metaphor for wealth accumulation.
It is. And this leads directly to the time value of money, which is just central to valuation.
Absolutely fundamental. John Law, the brilliant, infamous Scotsman from the 18th century.
The Mississippi Bubble guy.
That's one. He understood that anticipation is always at a discount.
Anticipation is always at a discount. Could you break that down? Does it just mean $1 today is worth more than $1 tomorrow?
Yes, that's the core idea, but applied broadly. Any future promise money, an event, anything, is always valued less today than having it right now.
Okay.
It's the fundamental reason we discount future cash flows when we value anything, whether it's a company or, a lottery ticket payout. It's why you'd rather have that slice of pizza now than be promised 2 slices tomorrow.
That makes perfect sense. And there's an inverse relationship here, right? A high discount rate means a low capital value.
And vice versa. Low discount rate, high capital value.
There was an anonymous pamphlet from 1621 that noted, "Land and money are ever in balance." So William Petty observed that without interest, an acre of land would be equal to 1,000 acres.
Exactly. It shows the power of that discount rate. And Adam Smith, in The Wealth of Nations, he saw that land prices actually rose as interest rates declined. It's all interconnected.
And this connection extends directly to investment decisions, doesn't it?
Straight to them. The Austrian economist Böhm-Bawerk had this idea that declining interest rates encourage more roundabout or time-consuming methods of production.
Okay, roundabout production. Does that just mean when money's cheap, companies are more likely to invest in huge long-term projects, things that might take years to pay off, even if they're risky?
That's exactly it. Think of it like building a massive, highly specialized factory that's the roundabout way instead of just buying standard equipment off the shelf the direct way.
Oh.
The roundabout way promises greater efficiency or output later, but it needs a huge patient investment up front. And low interest rates make that kind of patient investment far more attractive, almost irresistible sometimes.
Friedrich Hayek made it an axiom.
Okay.
All economic activity is carried out through time. Every single economic decision has a time dimension.
You can't escape it.
And this, of course, is where things can go wrong. Spectacularly wrong.
Right. If interest rates are kept below their natural level, as the Austrians would say, it can lead to malinvestment, misguided investments, projects that consume way too much time or money for their eventual returns.
Like what?
We're talking about expensive white elephant projects, bridges to nowhere, stadiums that sit empty, or those pie-in-the-sky technology schemes with no serious prospect of ever turning a profit.
They only look viable because money is effectively free.
Precisely. The low cost of capital distorts the calculation.
And we've seen historical echoes of this play out again and again. The Victorian financial journalist Walter Bagehot had that famous dictum.
Ah, yes, John Bull.
John Bull can stand many things, but he can't stand 2%.
Meaning low rates drive speculation.
Exactly. He believed low interest rates inevitably fueled speculative manias. Yeah. Because safe returns were so low that people felt forced into riskier assets just to get any kind of return.
And the Mississippi bubble in France, early 1700s, that's a prime and frankly wild example.
John Law's system, right, merging the National Bank with his Mississippi Company.
Yep. And the Royal Bank provided loans at a shockingly low 2% against share collateral. And the company itself bought back its own shares with zero interest loans.
Zero interest, wow.
Can you imagine? It created an absolute speculative frenzy. The anecdotes from the time are just incredible.
Like what?
People literally entering Law's study through the windows or falling down chimneys, desperate to buy shares.
No way.
Yes. Even servants were apparently speculating on their own account. An edict even had to be issued forbidding liveried servants from wearing expensive silks because they were getting so rich, supposedly.
That's insane.
And Law even forced paper banknotes on people and banned precious metals, trying desperately to prop up the system.
And inevitably.
It collapsed. Mississippi shares lost 90% of their value, falling right back to their 1718 levels. One economist later estimated the fair value was probably only about a fifth of the peak price.
A classic low-rate bubble. Shows what happens when financial gravity seems to disappear.
And we saw similar patterns in British financial crises in the 19th century, too.
Like the 1825 panic.
Exactly. Scottish bank loans fell to 2.5%. Prompting clients to pull deposits and pour them into speculative joint stock companies.
Uh-oh.
Yeah. The failure of Pohl, Thornton and Company illustrated how low rates led firms to try and make a profitable use of their capital by investing in risky long-term securities. The political economist Robert Torrens concluded quite bluntly that over-speculation was occasioned by the low rates of profit and of interest.
And of course, you can't talk bubbles without mentioning tulip mania. Dutch Republic, 1630s.
Another vivid illustration, directly linked to easy money as rates fell from around 8% down to 4%.
So people needed somewhere else to put their money.
Right. Joseph de la Vega noted at the time that even the wealthiest men are forced to buy stocks because the revenue from investments at fixed interest becomes less. If you can't earn anything safe, you start looking for risky bets, tulips in that case.
Then the railway manias.
Yeah.
1840s, 1860s.
Same script, different asset. Money was abundant, leading to these grand visions of every railway to pay 20% as safe as the Bank of England.
Famous last words.
Indeed. People, as Bagehot said, simply could not stand 2% secure gain. They were desperate for higher returns, whatever the risk.
Even the collapse of Over and Gurney in 1866, that prompted Marx to observe something interesting.
What was that?
That high interest could indicate roving cavaliers of credit who can afford to pay a high interest because they pay it out of other people's pockets.
A striking way to put it. Describes the riskiness fueled by easy credit.
And this pattern wasn't just domestic, right? It went global.
Oh, yeah. The foreign lending mania of the 1870s, you had countries like Egypt promising a fantastical 10% return.
10%.
Which completely blinded investors to the fact that the Khedive's debts were already 15 times his annual revenues.
Ouch.
Bagehot famously warned against lending to semi-civilized countries lacking a continuous polity and fixed political morality. The underlying message was clear. Easy money leads to reckless lending and borrowing, both at home and abroad.
Okay, let's fast forward to the 20th and 21st centuries.
Yeah.
This is where we really entered the age of easy money and its accompanying bubbles, wouldn't you say?
Absolutely. The Roaring '20s, there was that pivotal July 1927 meeting of top central bankers. Benjamin Strong from the New York Fed pushing for lower rates.
Right, but wasn't there pushback?
There was. Reichsbank President Helmar Schacht famously retorted, "Don't give me a low rate, give me a true rate, and then I shall know how to keep my house in order."
He saw the danger.
Clearly. But the Federal Reserve's mandate for an elastic currency after 1914, allowing for this fine-tuning, well, it inadvertently paved the way for easy money policies.
And the result.
Credit growth outpaced economic growth, broker loans soared, the S&P composite climbed nearly 30%, and then boom, the 1929 crash.
And that U.S. easing had international consequences too.
Definitely. Higher U.S. rates later drained the world of capital, leading to gold losses in places like Germany and Britain. It wasn't contained.
Japan's lost decades, another stark example.
Oh, absolutely. After the 1987 Louvre Accord, the Bank of Japan tried to support the dollar, cut its discount rate to a post-war low of 2.5%, and kept it there for 2 years.
And the Bank for International Settlements, the BIS, they criticized this later.
They did. They said the Bank of Japan's singular focus on price inflation arguably blinded them to what was going on in credit markets and the potential for financial disruption. Basically, they missed the massive asset bubble inflating right under their noses.
Then came the Greenspan put, after the long-term capital management near failure in 1998.
Right, this sort of unwritten contract that the Fed would step in to halt big market declines.
Basically creating a safety net for investors.
Exactly, which, fueled a near threefold gain in the NASDAQ. Why not take risks if you think the Fed has your back?
And the danger there is it incentivizes more aggressive, riskier bets, right?
Right.
Because the perceived downside is limited.
Precisely. It's like having insurance against your own bad decisions. And then Ben Bernanke, who joined the Fed in 2002, he held the view that asset price bubbles were basically impossible to identify in real time.
So don't try to prick them.
His view was that monetary policy should deal with the aftermath of bubbles, not act preemptively. He even famously advocated helicopter money to prevent deflation.
And so the Fed funds rate was cut to just 1% in 2003 and stayed low for years.
Which certainly seems to have set the stage for the massive U.S. housing bubble that followed.
Though the Fed initially denied its policies played a role.
They did. They blamed a global savings glut. But some within the Fed, like William Poole from St. Louis and Thomas Hoenig from Kansas City, later admitted that, yes, low rates did fuel the boom.
And it wasn't just a U.S. phenomenon.
No, because of the special position of the dollar as the global reserve currency, the Fed's low interest rate policy after 2002 effectively created the conditions for a global credit boom. It exported that easy money mindset worldwide.
And the innovation, or maybe the expansion, of these easy money policies didn't stop after the 2008 crisis, did it?
Not at all. We saw the advent of quantitative easing, or QE. Central banks everywhere started these large-scale asset purchases. The Fed's balance sheet alone more than doubled to over $2 trillion by late 2008.
And this period gave rise to some truly bizarre valuations, didn't it?
Utterly bizarre. Take the Swiss National Bank shares, SNB shares.
Okay.
They soared from about 1,000 francs to over 8,300 francs.
Wow. Must have been a huge profit growth.
Nope. They had a fixed 15-franc dividend that hadn't changed since 1921.
So why the surge?
Because the yield on 10-year Swiss government bonds was near zero. Mathematically, that implied an almost infinite valuation for the SNB shares, even with that tiny fixed dividend. It's mind-bending.
It truly is astonishing. Does this suggest just a fundamental breakdown in rational valuation, or is there some kind of, twisted logic to it?
Well, mathematically, when the discount rate, the interest rate you use to value future income gets incredibly close to zero.
Yeah.
The present value of any future income stream, no matter how small or fixed, starts to shoot towards infinity. It's a quirk of the math when alternative returns vanish.
So it's not entirely irrational in that specific mathematical context.
Perhaps not strictly irrational from a pure calculation standpoint, but it certainly pushes the boundaries of conventional economic sense and signals something very strange is happening in markets.
And global housing markets went wild, too.
Completely. UK house prices became unaffordable relative to income, but seemed cheaper relative to mortgage costs because rates were so low.
Some Danish home buyers were even being paid to take out mortgages, right? Negative rates.
Incredible, isn't it? Paid to borrow money. And you saw record price-to-income ratios everywhere. Vancouver hit 10 times average income. Sydney hit 12 times. This wasn't just a local issue. It was global.
And this search for yield also spilled over into stocks.
Oh, definitely. It led to what the book calls nosebleed valuations for concept stocks. Companies like Tesla, Beyond Meat, valued more on future hope than present earnings.
There was even marijuana madness.
Yes. A Canadian cannabis producer briefly outvalued American Airlines, based purely on hype and cheap money, not fundamentals.
And then there's crypto. Bitcoin.
No.
described by some as a zero-coupon perpetual note.
And intrinsically worthless by others?
It became wildly popular in this age of ultra-low rates that seemed to make rational valuation, well, almost impossible.
Its price swings were even more extreme than the Mississippi Company's 20x climb. History rhyming again, perhaps louder this time.
All this surge in asset prices created what's been called the virtual wealth bubble.
That's right. U.S. household wealth nearly doubled between 2009 and 2018, exceeding $100 trillion. That's 5 times U.S. GDP.
But how real was that wealth?
Well, it contrasts sharply with older definitions of wealth, like John Stuart Mill's or John Ruskin's warning about a gilded index of far-reaching ruin. The argument is that much of this millennial wealth was just mere claims to wealth, whose paper value multiplied simply because the discount rate declined.
So it sounds like this virtual wealth is less about true economic growth, like building factories or creating jobs, and more about like a financial illusion. What's the deeper insight for us if our wealth isn't tied to productive activity?
I think the insight is that when wealth becomes primarily a function of asset price inflation rather than real production or innovation, it can mask underlying economic fragility. It creates the sense of prosperity that might not be sustainable. It makes the whole system much more vulnerable to sudden shocks or corrections when the gravity of interest rates eventually returns. It could be like a house built on sand.
The COVID-era market frenzy felt like something out of Lewis Carroll's Financial Wonderland.
Absolutely. Bonds subtracting interest, companies worth more bankrupt than operating.
Gabe Portnoy, the stock promoter, he even tweeted about the market being disconnected from reality. The whole thing is a pyramid scheme. We're living in the matrix.
Strong words, but they capture the feeling of detachment many felt.
And a truly compelling aspect here is the meme stock phenomenon. Hertz, GameStop, AMC.
Driven by the Wall Street bets crowd, their YOLO mindset. You only live once, and FOMO, fear of missing out.
Creating what some called mob rule rather than a true democratization of finance.
It certainly raised questions about market structure, and as Warren Buffett wisely put it, interest rates are to the value of assets what gravity is to matter. Remove that gravity with ultra-low rates, and things just float off into the stratosphere, disconnected from underlying value.
Okay, this brings us to the profound, often unintended consequences of these unnatural low rates.
Yes, the fallout.
The U.S. economy, for instance, became slowly financialized. The fire sector, finance, insurance, real estate grew 50% larger than manufacturing.
That's a huge shift. And a natural consequence is that these ultra-low interest rates directly facilitated corporate mergers and borrowing, which in turn significantly boosted Wall Street's income.
And led to the rise of these platform companies, like the old trusts.
Exactly. Companies reminiscent of the robber baron era trusts, like Kraft Heinz, Valen Pharmaceuticals, using cheap debt to finance huge, often anti-competitive mergers. They could borrow cheaply and just buy out the competition.
And the number of listed U.S. companies actually halved in just 2 decades?
Quite a consolidation. And our sources suggest price-fixing cartels are actually more influenced by low interest rates than any other single factor.
Wow. And private equity comes under criticism, too.
Yes, for often focusing on wealth extraction, not wealth creation, sometimes cutting long-term investment to load companies with debt and pay themselves fees.
This also had a direct impact on how companies behaved internally.
Massively. Driven by this mantra of shareholder value, companies prioritized share repurchases over investing in R&D, new equipment, or employees.
Using debt to buy back their own stock.
Right. These debt-funded buybacks, in some cases, were described as a slow-motion leveraged buyout of the entire stock market. They boosted earnings per share, making companies look better, even if their actual profits were flat or declining.
Some were even likened to Ponzi schemes.
Some were, like Exxon and IBM were mentioned in the source, because they were essentially borrowing huge amounts just to prop up their share price through buybacks, not necessarily to grow the underlying business.
And while this was happening on Wall Street, what about the average person's financial security?
It was hit hard. We saw a dearth of savings in the U.S. Households saved less, borrowed more, contributing to what some call a balance sheet recession, where people focus on paying down debt instead of spending.
And pensions, a huge problem there too.
A massive crisis in traditional defined benefit pension plans. Trillions of dollars in deficits globally, largely because declining interest rates blew a hole in their funding models.
And that has real-world consequences.
Absolutely. It led to cuts in public services funded by pensions, reduced corporate investment as companies diverted cash to plug pension gaps. It became a Sisyphean task for pension managers just to tread water.
The numbers are stark. Millions of Americans, Japanese, projected to outlive their savings by years.
A huge retirement gap opened up.
Perhaps one of the most troubling consequences discussed is the impact on inequality and populism.
A very strong link is drawn. Falling bond yields since the 1980s are directly correlated with rising income and wealth inequality. The idea is almost a feedback loop. Low rates begot inequality, and inequality begot lower rates.
How does that work?
Well, low rates boost asset prices, stocks, property which are disproportionately owned by the wealthy. They're wealth balloons. Meanwhile, savers relying on interest income get squeezed.
And you see this reflected physically.
You do. In the soaring incomes of top executives and private equity bosses, Steven Schwartzman reportedly earning nearly $800 million annually at one point. And it's literally etched onto city skylines.
The pencil towers.
Exactly. Those super tall, super skinny, super expensive skyscrapers in places like New York, described as elite displays of wealth, only feasible because cheap money made hyper-expensive real estate a rational place for the ultra-rich to park capital. They're a visible signal of rising inequality.
Meanwhile, the middle class
Declined across the developed world. 2/3 of households in the U.S. and Western Europe saw real income declines or stagnation over a decade. You see the student loan crisis, young people struggling to afford homes. It's a direct outcome of assets becoming wildly expensive relative to wages.
These low rates also encouraged more risk-taking and regulatory arbitrage.
Definitely. Interest can be seen, in a way, as the price of insurance against risk, when that price is near zero.
People take more risks.
Exactly. It led to an insatiable appetite for higher yields, driving outsized lending to riskier borrowers and fostering dubious underwriting practices. If safe returns are non-existent, you have to go further out on the risk curve to get any return at all.
Okay, for those of us not deep in the bond market, what's the simplest way to understand why duration risk became so dangerous, especially with negative yielding bonds?
Right. Imagine you buy a bond that literally promises to pay you back less money than you put in. It's already a guaranteed loss if you hold it to maturity.
Okay, bad start.
Very bad start. Now, if interest rates then start to rise from those ultra-low or negative levels, the market value of that bad deal bond you're holding drops even further and potentially much faster than a normal bond would. The longer the bond's duration, the bigger the hit. It's like holding a hot potato that gets heavier and burns hotter the longer you hold it, especially when rates go up.
Which is why James Grant called it the biggest bond bubble in world history.
Precisely. Huge potential for losses baked in.
And liquidity risk also became a major concern.
Yes. As Keynes put it, interest is partly the reward for parting with liquidity for tying up your money. When rates are near zero, investors chased yield into less liquid assets.
And then couldn't get their money out.
Exactly. We saw in cases like the H2O fund, Third Avenue, where investors suddenly rushed for the exits and discovered the fund held hard-to-sell assets, a classic sign of illiquid love reaching for yield without fully appreciating you might get stuck.
Then there was Volkswagen in February 2018.
Right. A sudden spike in market volatility. Complex volatility targeting strategies blew up, causing the VIX index, the fear gauge, to double in a day, evaporating something like $1 trillion in virtual wealth.
A glitch in the matrix, as one observer put it.
Yeah. Wealth vanished almost instantly, not because of some fundamental economic disaster on Main Street, but because of the interconnectedness and fragility built into the financial system by years of low rates and complex strategies chasing tiny returns.
This also brings us to regulatory arbitrage. Regulations like Dodd-Frank, Basel III, they exploded in complexity.
Hugely complex, thousands of pages. But the argument is, clever financiers can always find loopholes, especially when low rates provide such a strong incentive to find ways around the rules to squeeze out extra yield.
It's a contrast with the old days, the raised eyebrow.
Exactly. The source mentions the raised eyebrow of the Bank of England governor in the past. Sometimes a stern look was enough to curb risky behavior. Now, ultra-low rates incentivize this relentless search for loopholes, making regulation feel like a constant game of whack-a-mole.
And finally, these unnatural low rates. They contribute significantly to economic sclerosis, stagnation, and political instability.
That's a major theme. Economists like Clement Juglar and Joseph Schumpeter saw economic volatility, recessions even, as a necessary source of vitality. Capitalism, Schumpeter said, never can be stationary. Creative destruction.
But low rates prevent that.
Arguably, yes. They put the brake on Schumpeter's evolutionary process. They lead to unnatural selection, keeping alive zombie companies that should fail but survive purely because they can borrow incredibly cheaply. This leads to capital destruction through misallocation. Capital gets stuck in unproductive terms.
And the decline in productivity growth across the developed world. This is a conundrum for central bankers.
It was. And this misallocation of capital to zombie companies is seen as a key part of that puzzle.
We even saw this in China, the development disease.
Yes. Easy money led to wasted resources on a grand scale, flattening mountains for questionable projects, immense buildups of debt and associated corruption.
And the political implications are alarming.
Deeply alarming. If, as the saying goes, democracy abhors economic stagnation.
Then democracy itself is threatened.
Exactly. By these long periods of sluggish growth and rising inequality fueled by low rates, we've seen weakening support for democracy, especially among younger generations who feel left behind, and the rise of populism across the West.
Figures blaming central banks.
Yes. The German finance minister Wolfgang Schäuble reportedly blamed the rise of the AfD party partly on the ECB's negative rates. Donald Trump denounced the Fed's policies as creating a false economy. There's a direct line drawn between monetary policy and political discontent.
Yet, are there alternatives? The book mentions the Icelandic counterfactual.
Right. After their 2008 crash, Iceland took a very different path. They let the major banks fail. They prosecuted bankers, actually jailed about 24 of them.
Really?
Yes. And crucially, they protected domestic depositors but imposed losses on foreign creditors. The result, Iceland experienced a surprisingly strong economic recovery.
So it demonstrates an alternative.
It suggests an alternative path to the typical central bank interventions, the bailouts, the QE seen elsewhere. It implies that sometimes taking the short-term pain of letting failures happen, of allowing that creative destruction, might lead to a healthier, more sustainable recovery in the long run.
It really makes you wonder, doesn't it, when you look at all these historical examples, this pattern.
Yeah.
It seems so clear. Whenever interest rates are artificially suppressed,
it creates this powerful incentive for misallocation of capital, for speculation, often with really severe social consequences down the line.
What a journey this deep dive has been. We've really seen how this seemingly simple concept, interest, is just profoundly interconnected with, well, every facet of our economic and social lives.
Absolutely. From ancient Sumerian farming right up to today's complex financial markets, interest rates aren't just numbers. They are powerful drivers of human behavior, investment decisions, and even social stability.
And we've definitely uncovered a recurring pattern, haven't we?
We have. When interest rates are artificially suppressed, pushed down below where the market might naturally set them, or when they get disconnected from fundamental economic realities.
It often fuels speculative bubbles,
incentivizes risky behavior,
exacerbates inequality,
erodes savings,
and can even contribute to economic stagnation and political polarization. The historical warnings, like Badge Hott's about 2%, they just echo so loudly in our modern world, an environment where, as the book suggests, low rates begat low rates, creating this self-perpetuating cycle.
It really does feel like we've been living through an extraordinary period.
Which raises, I think, an important question for you, our listener, to maybe ponder. What if the very policies designed, often with good intentions, to bring stability to our financial system, what if they are, paradoxically, cultivating a false economy?
One that appears prosperous on the surface may be propped up by asset prices.
But risks that far-reaching ruin, as Ruskin put it, lurking beneath. And if that is the case, what does that mean for how we define true wealth, real prosperity, and sustainable growth going forward? Something to think about, perhaps, as you look at your own savings, your investments, or just digest the daily economic news.